let's go through this. We talked about accounts receivable and how the natural sort of driver for that is the revenue growth rate. Well, with inventory, the most natural driver is cost of goods sold, the growth rate of cost of goods sold. And the reason for that is because inventory represents the items that cycle through the income statement via cost of goods sold. And presumably, the more cost of goods sold you expect to generate, because JP Morgan forecast in year one, for example, a small decline in revenue and slight gross profit margin improvements or whatever the forecast is. Well, the JP Morgan forecast that we relied on are saying something about cost of goods sold in 2021 compared to 2020, right? And so there's a growth rate there. And presumably, unless you're modeling specific changes in terms of the relationship between inventory and cost of goods sold, those are naturally aligned. You're going to need a certain amount of inventory to support the amount of product that you expect to sell. And very similar to accounts receivable, the relationship between revenue and AR, unless you have a thesis, should generally stay the same, and the same goes for inventory. The relationship between cost of goods sold and inventory should generally stay the same unless you have a thesis. And like I said, we will walk you through how to build a schedule where you do want to model a thesis about, say, changing inventory turnover. If you don't assume a change in inventory turnover, which is sort of the parlance of sort of defining a relationship between inventory and cost of goods sold. How quickly am I sort of cycling out my inventory? Same way as day sales outstanding is the sort of traditional metric for connecting revenue and accounts receivable. Well, here, unless we have a thesis, we're just going to go with the cost of goods sold growth rate. Now, we never in our model actually specifically define a cost of goods sold growth rate. We just forecast it based on a margin assumption, but it's going to be fairly trivial for us to back into what an implied cost of goods sold growth rate is when we're trying to forecast inventory. Notice again, we're relying on JP Morgan, but indirectly now, because we directly looked at the JP Morgan forecast on the income statement, not so much on the balance sheet. Here it's just indirect. Prepaid expenses. So, depending on the nature of prepaid expenses, the way to think about this is, well, where did these items cycle through on the income statement? The driver is what's happening on the income statement with these expenses. Eventually, prepaid expenses are going to hit, rent expense is going to hit SG&A, utilities is going to hit SG&A, insurance and wages, these tend to hit SG&A. Now, because you don't know exactly whether it only hits SG&A, maybe it hits cost of goods sold or maybe some other operating expenses for companies, what you'll see a lot of times is people simply growing this with the revenue growth rate, just like here. So this is kind of a fielder's choice. If you are confident that it's mostly hitting SG&A, grow with the SG&A growth rate. If you're not, revenue. That's kind of the baseline assumption. I should say you'll see some models do that here as well, where they'll say, well, I don't necessarily know that inventory is directly all through cost of goods sold. Most of the time, inventory does cycle almost exclusively through cost of goods sold. So this is a safer bet. Here, it's a little bit less safe. And so revenue growth rate is kind of a second and totally reasonable option if you don't know for sure where these items ultimately cycle through on the income statement. That's what I said. There isn't always just one right answer here. Accounts payable. This one's a little bit trickier than inventory, but to some extent, what generates accounts payable is the question to ask. Well, for Apple, most likely the things that are generating their accounts payable are going to be the money that's owed to suppliers for creating the iPhones, and therefore the inventory relationship, and therefore indirectly the cost of goods sold relationship is probably the best driver, but we don't know for sure. And so again, revenue growth, no matter what, as the business grows, you're going to presumably, assuming the historical relationship holds, it's either revenue or cost of goods sold growth rate that's going to be a reasonable sort of forecast driver here. Again, if we have a thesis that all of a sudden, we're going to get more aggressive with our suppliers, we're going to take longer to pay, that's all possible. We need to build more model functionality for that. For now, all we want is the most simple connection. Accounts payable grows as the cost of goods sold growth rate increases or the revenue more broadly increase. Deferred revenue, that's an easy one. As you sell more stuff, whether it's gift cards or iPhones or whatever, the revenue growth rate is going to be the driver here. So that's an easy one. Accrued expenses, same story. It's either SG&A or revenue. The lowest common denominator in all these working capital items is almost always going to be revenue. And that's why you see some models just not even bothering trying to make these distinctions, just simply growing it at the revenue growth rate across the board. Last but not least, tax payable. Theoretically, this could be grown at the rate the tax expense on the income statement is going to grow. tax growth rate. Presumably, as our taxes grow, the tax payable should grow accordingly. Again, lowest common denominator is always revenue. That's always a viable option. So as you can see here, the framework is to tie working capital items to their closest operating match on the income statement.